Hi, this is Stacey Winn with Americap Development Partners. I'm here today with Justin Clark. He has recently done an exhaustive survey of most of the institutional lenders in the business, and I'd just like to learn a little bit about what he accomplished during that survey. So Justin, thank you so much for joining me this morning. So tell me, what exactly are the big guys looking to invest in nowadays?
Right. And the institutional model is very interesting right now. Contrary to popular belief, capital is still relatively patient. Some of the drivers are some form of income production. Now, whether that's on the residential building side, having standing lots or standing inventory that you can sell today, or the traditional condo, apartment, some retail aspect built into it. It's all about a little bit of income in the beginning, selling off, or traditional condo and apartments, and then the big dollars at the end.
Now, you touched on this a little bit. What type of real estate specifically do you see them having an appetite for?
Right. So again, on the income producing side, the other drivers that would battle that would say, if it's residential, I need to be making 20% IRR on my money or more. If it's income producing and residential or commercial, I need to be making at least 12% with that income producing model.
So you would say that there's not necessarily a type that they're looking for. They're looking for good deals, and they kind of decide that on a case-by-case basis.
Right, and it's population driven. It's how easy or difficult the city is willing to work with you. And it's how densely built out the area. So infill projects.
Interesting. Now, would you say that they're currently capitalized, or they're raising capital right now?
Right. Big question. The bigger firms, the bigger institutional guys are very well capitalized today. The interesting formation that we have yet to see completely shake out are the residential funds that were attempting to raise in 2007 and 2008 never really got off the ground. Investors didn't want to throw money into it. The commercial funds that got off the ground in 2007 were able to raise capital because commercial was still booming a little bit, right? So the commercial funds were meant to buy dirt today, or commercial projects today. Their product's gone now. So now they're starting to move into the residential market because the money they raised isn't making much in the bank.
Interesting. Now, what type of groups would you say they're looking to invest in right now?
And here's the biggest question, right? Do they care about legacy issues or not? The older firm that has been around forever, that they've done 2,000 deals with, that gave them legacy issues over the run-up, or is it the bios of the newer companies, and newer I mean 5-year-old and up, right? Not brand new. But really what we're seeing is the majority of the institutional relationships are actually double handshakes. They are actually following the bios, right? They're following their relationships at the companies. So if the bigger guys had to let go of a few people, the institutional dollars are probably following those bios more than just a brand.
So it was more important to them the name on the business card as opposed to the company that was printed on it.
Well said.
They're following those relationships.
Right.
That's interesting. And again, you did touch on this, but how big of a role do the legacy issues actually play in the decision-making process?
Sure. And the media wants to make it seem like everybody's Bernie Madoff, right? It's sensational. People like to see it. It's relatively interesting. The truth of the matter is, legacy issues were on a deal-by-deal basis. Some people got burned, some people didn't. Legacy issues are really not as big of a deal we're finding as we initially thought, or some initially thought. It's really the strength of the bios, the strength of the handshake.
Now again, you really emphasize that, having a strong bio and those relationships. So just to reiterate, in what you found, the strength of the individual and the strength of the relationship is more important than the company being in business since 1803 or something like that.
In today's market, yes.
Interesting. Now, what exactly are they looking for from the sponsor side?
Right. So in 2006, you would have said, look at all these deals I have. You guys throw in the cash, I'll throw in our expertise and our building arm. Today, it's the sponsor saying, well, look, because you're new to the market or you have legacy issues so we don't trust you anymore, we want to see 10% or 20% of the capital come from your end.
From the sponsor's end.
Right. Come from the sponsor's end, which is interesting and creates, if you have a little bit of cash, creates amazing opportunity because now you're no longer just that middleman. You're in the deal pari passu to the institutional money.
Get in the game.
Right.
Okay. And what size investment seems to be most appealing, or is that more of a case-by-case basis also?
Well, this was one of the interesting questions we had. Initially, the institutional dollars, you have to remember, these funds are built around $100 million and up. So $500 million funds probably on average. If they don't place $10 million worth of capital, is it worth their time? So initially we were finding we want to see deals between $10 and $20 million, otherwise give us a call back when you can find them. What we're seeing today is those $10 million deals have something in them that are not attractive. Whether it's 60% raw dirt that you can't sell for another 15 years, or what have you. So we're finding today they're saying, look, group up a few deals, put 3 deals together that are $4 million apiece, and that's where our interest will behold.
That's really interesting. Now, just to kind of wrap up, would you say that deals are happening today? Are people willing to write those checks, or is everybody still, keeping their hand on the pocketbook?
Right, and the big news is the money on the sidelines, right?
Yeah.
I think I heard something yesterday where twice as much capital is currently sitting on the money market accounts as there was in 2006. And in 2006, I think it was something like 1.6 trillion.
Oh my goodness.
So there is a lot of money on the sidelines, but deals are happening today. People are savvy. They know if I get in today or if I get in 6 months, this is a 3-year deal. Why would I wait and let somebody else jump on the deal that I like?
Excellent. Well, thank you so much, Justin. I found this really helpful, and I hope you continue with what you're doing. I look forward to seeing more from you.
Thank you.
Thanks, everybody, for watching.